Hi, Bob Anderson back again. Today I'd like to talk to you about finance. A great subject. I could talk about it probably for a week on finance. But I just want to talk to you about the different types of finance that you can use when you're doing a development project. Now, remember when a few episodes back when we talked about buying the actual site. So what we were buying is a bit of a dilapidated old house on a block of land with development potential. Because it didn't have a building approval, it's not classified as a development project by a bank, by a financier. Not until we got a development approval. So all it was, a simple investment loan. That's all it is. And you just operate that, probably negative geared if you like, until you get your approvals through. Now, once you've got your approvals through, your development approval particularly, it's considered to be a development project by a bank. And at that point, there could be a couple of ways you can go. Depending on the size of the project, there's two types of finance. Keeping it simple, you've got what we call normal retail finance. So that's the same sort of finance you would have used to buy your house or buy an investment property. And then the other part of that, we've got what we call commercial finance. Commercial finance takes different types. I mean, it could be if you're buying a shopping centre or an industrial building, that's a type of commercial finance. But there's also a type of commercial finance that relates to property development. So that's what I'm talking about. So you might be able to use retail finance. This is when you've got your development approval. What I'm talking about now is when you need to get finance to proceed with the project and get it built and get it sold or whatever you're going to do with it. It's that finance. It's not the finance we talked about earlier, the investment loan when we bought the property in the first place. So we've got a development approval at least, maybe even a building approval, construction certificate. We now want the finance to do the deal, to finish it. Now, on smaller projects, let's talk about townhouse projects here. If it's just a little splitter, normal retail loan. If it's a small townhouse project, up to probably 3 townhouses and maybe even occasionally 4, you can use what we call retail finance. It's a bit like, if you like, a house and land package. If you've ever done a house and land package where you buy a block of land, then you do a contract with a builder, 2 separate transactions. The bank will lend you the money to buy the land, lend you the money to do the building contract, and you end up with a house. That's what we call a house and land finance. Retail development finance is a bit like that. So you've got a parcel of land, if you like, with a development approval, and you've got a building contract with a builder. It might be for 3 townhouses. It doesn't matter. It could be a combination of those two. That's retail finance. It will be at the normal retail bank rates, normal application fees. What you will need, though, is 2 things. The same as when you bought your house or you bought an investment property. You'll need a deposit. You'll need a certain amount of equity in the deal. And you'll need to prove serviceability because every month you've got to put your hand in your pocket and pay your interest, same as you do on your house. That's retail finance. Commercial finance, it generally kicks in at about, let's say, 3 townhouses or bigger. It's a bit different. It's interest rates are a little bit higher than the retail loans. The application fees are a bit higher. The valuation we'll talk more about that in a moment, but you need a commercial valuer. So everything's commercial on the commercial loan, retail on the retail loan. And if you're doing 5, 6, 7, 8 or more, of course, it is a commercial loan. Now, all your normal banks, your big 4 plus some of your second tier banks, of course, they have normal retail banks. You see them, they're out in the suburbs, they have branches, but they will have a commercial area as well. Generally not in the branches, it might be back in the head office in the city, but they will have a commercial area. And on those sorts of projects, those slightly bigger ones, that's what you'll need to do. You need to access the right sort of people. Now, as I said, a slightly different finance. A little bit more expensive, interest rate wise, a little bit more on the valuations, a little bit more on the applications, but you can do bigger and bigger projects. But there is one big difference with commercial loans, and that is that the interest is what we call capitalised. So unlike the retail loan where every month we have to put our hand in our pocket and pay the interest, on a commercial loan, the interest component is actually loaded into the loan. It's capitalised. So what that means is every month when your interest is due, you don't have to put your hand in your pocket to find it. It's actually built into the loan. So each month, the bank will just take a little portion of that loan to cover the interest. I'll tell you, it's a lot easier to do that. Imagine if you're doing a 20 townhouse project and you're putting your hand in your pocket every month for, I don't know, 20, 25,000, whatever it is. No, capitalised interest, way to go, certainly on larger projects. And generally it'll kick in at about 3 or more townhouses. So commercial loans are a totally different animal. And when you get your loan, let's say a commercial loan, there'll be certain things to get it finalised. You would have to have chosen a builder. You can get a pre-approval if you like. You get what you call a terms sheet or a pre-approval where they say, look, we will lend you the money once you've done all these things. So you can find out fairly early on a commercial loan if you're going to satisfy the conditions, but actually get the money you have to satisfy the conditions. Those conditions could include, well, you have to have your certain amount of equity. Now, the good news is the bank will put in most. The bank might put in 75 or 80% of the money you need, but you have to put some in. So one of the conditions of them putting their money in might be, well, you've put your piece in first. You might need a building contract with a builder. You might need a commercial valuation that's up to date and they only last 3 months. You'll need a report from a quantity surveyor. You may or may not need pre-sales. I'll talk a little bit more about that when we talk about marketing. And you'll need your, if you like, your approvals. So certain things, once all those boxes are ticked, everything's sweet, the money will flow. So that's a quick wrap on finance. There's actually lots of other types of finance that I teach my students about. Even non-bank finance, 100% finance, equity lending, there's mezzanine finance. It's a whole world of finance. And if you get really interested in property development, you want to learn a lot of these creative strategies that I teach, well, the opportunity will come if you want to join me, join my property development course, and I'll teach you all that. But it's what I'm saying is there's always a way to finance a deal out there. But I've taken you through a few of the basics, a bit of retail finance, a bit of commercial finance, and yeah, I find finance really exciting. I find that's the clever part of property development as well. I hope you're finding it exciting, and I look forward to catching you again soon.